Hello everyone, today is April 15th and this is our last session of the YCAF trading course. As you could see, I don't have a lot of announcements, no comments. The only two announcements that I have is about upcoming events or upcoming classes that I think that you should take. So our first free session of the YCAF Trading Practicum course is going to be conducted on April 23rd. It's Tuesday, from 3 to 5:30 p.m. Pacific, so time-wise it's going to be the same 2.5 hours. The price for that is $598. For the for the Practicum alumni, the price is $398. So that's the pricing. First session, as I mentioned, on Tuesday, April the 23rd. Second announcement, and it goes to everyone. And I've already instructed my team to put everybody on the receiving end of the weekly links, weekly webinar links for the WMD sessions, YCAF Market Discussion. So for 3 sessions, I'm giving you a free access to this class. You will probably not be able to get the recording, so you'll have to attend live. But maybe I'll figure something out, so I'll have to see. But this is just an offer that is going to become kind of like a more or less consistent offer from us at the end of each cycle. So for the next 3 sessions, just come to WMD, check it out. You could submit the charts that you want me and Bruce to go through, and just kind of get a sense for the class, what it's about. And it's definitely a different, vibe and a different class, a different content, and so on and so forth. Okay, you don't have to do anything about that. Just if you don't receive an email from us with the webinar links on the weekly basis, usually those comes on Tuesday, then, definitely contact me. And if you have any questions about the practicum, also let me know. Okay, today we're going to conclude with the homework review, the homework that we did for the comparative analysis. And then we're going to talk about the YCAF Trading Plan Proforma. This is the Proforma that I'm going to show you as a step, as a process step, as to what needs to be done when we are going through the selection, when we are analyzing stocks, and then what it should lead us, what are the steps there. We're going to go through the case study for the YCAF Trading Plan Proforma, and then I'm going to give you homework. You thought that this is the last class and we're done with homeworks? Well, definitely not. So the homework is going to be for those of you who's going to sign up for the YCAF Practicum course, and even if you don't sign up, why don't you do it, right? YCAF Visual Backtesting. So based on the YCAF Trading Plan Proforma that I'm going to give you today, guys, I want you to use it in your backtesting, and then before today and the April 30th, this is when we're going to discuss your results, your homework results. You're going to have, about 2 weeks. So I think that's a sufficient amount of time, for this type of homework, which is going to be somewhat extensive. So we want in the second session to look at the results. I want you to, and I'll send you the messages, for those of you who have registered, as to what we're going to do, how the results should be presented. So it's going to be a little bit more like, presentation style. And then obviously the homework, just sign up for the practicum. Okay, great. Now let's do a really quick review of the homework, and I want to save us some time at the end of this session, if we can, to address any of the questions that maybe have not come to me via email, maybe something that is still on your mind after everything that we're going to go through today, some of the questions that we received today. And if there is something that is left, then definitely let's address this. And we're going to start with the homework review. So I've given you 4 individual stocks plus Qs as a market proxy. And I've asked you to identify a stock leadership, a leader that could potentially outperform all of the stocks. So let's just go through that. Okay, and here are all of the 4 stocks. I'm not going to go through them individually. I'm just kind of going to analyze. Well, actually, I should, because it's going to show the market. Okay, so let's just do this. So what we see here, before the trading range, even before that, we're seeing a lot of the strength on the way up, and that defines a prior leadership. Prior leadership is all about CO being in this stock, and CO is not getting out. We see that maybe there is some profit taken on the climactic action, but going into the, which is being shown here, a flash crash of 2010, May 6th. So we don't see any selling going into that. So no selling suggests the bias as a reaccumulation. And then we just want to confirm this bias, and we definitely do. We see how the stock is stronger, maybe less, well, depending on how we're going to view this, we could do this. So stronger, and then weaker. And look at where the weakness comes. Most likely, this is our phase C. All right, we could probably identify it like that. And then a minor sign of strength, minor backing up action, and now we are outperforming again. So strength on the reaction, not necessarily, well, yeah, strength again here, almost a double top. We're not reaching the top here, so strength here. So there is a prior leadership, there is a strength throughout the structure. There is definitely the structure that we like, the Wyckoff structure. We understand the timing of this structure. So that all suggests to us that not only the stock will go up, most likely it will outperform the market. So that would have been a good choice. Okay, so then the stock went up after this, 77%. And, you know, I am just, because these slides have been created a long time ago, I just was taking the percent on the move from one date to another, from the low, I think, to the high at that time. So it went up 77%. Whereas the market actually only went up, or at least Qs went up 32%. Obviously, we could talk about the, you know, the beta, you know, as to how the stock moves relative to how the market moves. That's definitely a very important point. But at the same time, you know, when you see what institutions are doing by using comparative relative strength tools, and you see that they're holding on to their supply and not presenting it to the market throughout either an uptrend or a consolidation, that suggests that there's going to be a continuation, and most likely the stock is going to outperform the market, and that's exactly what has happened. Stock number 2 was very interesting, and a lot of you guys kind of indicated in your solutions that this is the stock to pick. And I would say that yes, definitely there is a lot of elements of strength here. Not necessarily on the way up. We actually see that maybe on the way up, the latest move is not, you know, that aggressive as the move for the market. So we are seeing some weakness going into the top, and then we're seeing some weakness as we go to the downside. So weaker, 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 stronger. So this first element of strength is kind of very interesting. It happens in what retrospectively we obviously would label as phase C. So in phase C, we have some kind of strength that comes. And then look what happens next. Relative to the previous high, the price advances very rapidly. So strength again. The reaction is flat and much better than the market's reaction. So strength again. So we see three spots, three significant highs and tops that are giving us some indication that institutions now are interested in this stock. And also the way how momentum and the velocity has increased on the way up, and then the reaction is so flat, suggests that most likely momentum is going to continue. And I'm thinking that this is probably earnings. So that could define that pre-earnings momentum could define how the earnings are going to be biased. And also pre-earnings reaction also could do the same thing. Everything is strong and flat, suggesting that we're going to have a really good continuation. Now the biggest question is, well, the stock is definitely outperforming, strength. So we have this quite an interesting accumulation on the way up. So no worries, Cameron. So accumulation on the way up. We don't see it on the way down without the volume signature, and I don't see anything very drastic on the way down. It's more on the way up. So there is some kind of urgency to accumulate this position. So this looks like definitely an outperformer. The only problem with this stock is that it has already advanced quite significantly off the lows. From 175 we get to 300, so that's about what? That's about, like 60% or so. Whereas, let's say stock number one that we looked at was not like that. It's still in the trading range. So stock number two was also a really good selection. Let's look at the result. This was Priceline, and we're seeing that look how this move right here, this rally, 76% instead of 13% by the market. So quite an outperformance, quite an urgency to get into this position as soon as possible. And after that, Priceline, after this point, still went up 70%. So the first stock, I believe it was CMG Chipotle, went up 77. This stock went up 70%. And believe me, I would take any of them. There is really would not be a big complaint from me if, let's say, I pick a Priceline that goes up 70% in the same period of time over Chipotle. It's just really not that important. Okay, let's look at the third one. Well, the third stock is in the downtrend, and we are seeing that maybe this whole move up was kind of like an area of a redistribution from the previous move down. Obviously, there is a lot of underperformance here. I'm not going to go even through this, but all of this here is weakness, underperformance. There is not a single point where the stock is outperforming the market. Maybe only on the flash crash itself, just because it's just such an extreme oversold condition. So would we be interested in a stock like this in the market that is either trading horizontally or we see some leadership that is already trying to break out? Well, most certainly not. But it doesn't mean that the stock cannot travel. think about the oversold condition that this stock is in right now on this chart. So we kind of have an oversold condition here, and then maybe another oversold condition. If the market is going to go up, the market has such a gravity that it's going to push the majority of the stock with it. It's going to take it with it. So we could expect some kind of rally from here. If we define the timing of the market as like the appropriate time to have some kind of momentum rally, where momentum for the market is going to increase, what are we anticipating with that momentum increase? We anticipate that a lot of institutions going to come to the market and they're going to see some value and they're going to start buying. That buying is going to produce a buying wave that's going to see a lot of volume signature, and price movement. So that price movement might be much better than the previous rally. So we might be also thinking the same way for this stock, that the next rally is probably going to be better than the previous rally, than this one. But it's still within the confines of the downtrend idea. It is still within maybe the confines of a trading range, where we could observe that this rally was maybe a change of character, and this move to the downside was a climactic action, and we are most likely where? We are most likely in phase B at this point. So the rally, aggressive rally, let's say into maybe an upthrust situation is possible, and you might be thinking here, okay, well, is there going to be a swing trade of some sort? Yeah. So from, let's say, 45 to about 60, that's about 30%. So that's your potential high probability short-term swing trade. But when you think about this candidate against the first two, would you really go for this one? I mean, even if it's gonna go, let's say, to the highs here, obviously, percentage-wise, it could be the same percent. But I'm not sure if you're gonna feel comfortable being so contrarian among the selection stocks, where you have very, very high probability selection candidates. Okay, let's see what this stock is. Research in motion. And even though, yes, there are no signs here, it still moved 60% to $70. So to this line right here. So you can imagine if you were in a swing trade, that would be, first of all, a good swing trade. That's number one. Secondly, you just the logic that we had for the trade into the upthrust high, that would work out really nicely, and that would be a really quick move on. So it's possible, but yet not preferable, not something that we would prefer to see. Okay, last one. Okay, so this one is kind of the most interesting one for different reasons. Let's just go through this really quickly. So we have an outperformance on the last rally to the upside. Definitely the stock is outperforming the market, so strength. Then on the flash crash, we don't have that kind of like general capitulation that we have in the market on that particular day. So that's great. That also is an element of strength. They don't want to sell it on a flash crash. If anything, they want to keep it so there's no volatility. By this stock, we wouldn't even know that the flash crash has happened. And then outperformance throughout. All of this outperforming, and then weakness, and then weakness. So think about the whole story here. We have a prior leadership on the way up. So SEAL does what? Holds supply. SEAL does not present supply to the market. And then we see that on the flash crash, no selling by the CO. And then throughout this whole picture right here, there's no selling really. It's all strength, strength, strength throughout. Maybe there is some, some small pockets of weakness, and then we go into the pocket of weakness. So I wonder if you guys remember this. We kind of studied this when we were going through the comparative analysis. Where for the stock that is exhibiting the prior leadership and strength throughout this whole trading range, could we find a short-term weakness? At which structural spot, or maybe like which potential phase could we see that? Do you guys remember? Yeah, phase C. That's correct. So potentially we could say, okay, is this a potential phase C? Well, let's go through some of the elements here. So we could say that our first test is going to be in phase A, somewhere here. Our second test is going to be in phase B, so probably somewhere here. We have like intermediate test right here on the way up. This is more in the structure of the move to the upside. So second test and then third test. When we look at the point of fear, we probably would be confused here because we would be thinking that the first point of fear is obviously on the change of character itself. And then the second point of fear should be into phase C if we're identifying it as phase C. But the previous reaction also catches our eye. The spread is increasing there, suggesting more of the sell-in, and that leads to the lower high, a failure to reach the previous high, and then leads to a lower low. So definitely this is where the selling has started. So we could either think of this as the beginning of the selling and this is just a continuation, or we could be thinking that the second point of fear is still on the latest reaction just because it has created a lower low. So think about the weak hands. For them to see their stock going below the support is going to be very worrisome, and they're going to give up their positions. So that kind of presents that second point of fear. But I must say that, it's definitely not as clear. And I would be thinking that this previous reaction could be phase C as well. So if that would be the case, how would we trade this? Let's say if we're thinking this way, A, B, and C, how would we trade that? We probably would get into this position on this bar right here. This would be the bar that overcomes the point of local resistance after the test at the support area. So a test, breakout above this resistance right here, and we would be actually okay going, the first 2 days into this. And then this type of failure in the half of the trading range, that's what would stop us. And most likely we would be thinking about exit, not necessarily where our stop loss would be. So our stop loss is going to be somewhere here. We're probably thinking of an exit after the failure, somewhere in this neighborhood. If we're late to that, something in this neighborhood right here. We don't necessarily want to participate in the potential sign of weakness. So that trade could be closed like that. Having said this, there is something very interesting that is happening with the analysis between these two reactions, number one and number two. Look at how on the reaction number one, as I've mentioned, we see the increase in the downward spread. So that suggests that there is some selling behind it. Now, with that increase in selling, we would have an expectation that this would increase the downward result. And it does kind of like suggest characteristically that there is some selling. But does it really, really, really produces the result that we want? Because if this is phase C in the distribution, then what should happen next? We should have a major sign of weakness in phase D, and then an LPSY that's going to come to the point of the resistance that acted before as the support. And we obviously don't see that. We don't see the commitment to the downside that the major sign of weakness should produce. We don't also see that rally. If anything, it's too aggressive, comes almost to the previous high. So that doesn't look like an LPSY rally either. So we don't see the increase in the downward result. And that suggests, if anything, we see a decrease. And that suggests a bullish bias. That also suggests, in long term, that also suggests this failure right here. It suggests that the short-term picture is bearish. And this is where a lot of these students and traders kind of, are confused about what's going on. Because some of the elements are showing that we are in the bearish bias, at least for now, with all of those failures. And yet that the long-term structure supports a bullish bias. So it's in those situations where you have to think in terms of how characteristically the next reaction is going to unfold and what kind of result that reaction is going to have. So let's look at that. Again, I'm going to take reaction number one, reaction number two. So thinking about reaction number two, we're thinking about, let's say, a down spread. And we're probably seeing that on the way down in the first reaction, we have quite a few big, large down spreads. On the way down in the second reaction, we see the largest spread at the beginning of the move, and then closer to the end. And usually what it tells us, whereas look at all of this. So usually it tells us that there is some sell-in off the top, and then there is potentially some buying off the bottom. So this would suggest that we could be in phase C. Now, the only thing that we would be looking for is some kind of confirmation. And that confirmation should come as, first, price should return into the trading range. It should be above, price should be above resistance that acted before as a support, this line right here. Third, if this is phase C and a spring, and it looks like, yeah, maybe it is. There is only one commitment to the downside, one progressive close to the downside. So if this is phase C plus this spring, then we definitely need to see some kind of test which is viable. And plus we need to see some kind of local breakout. So something like this, where it tests, and then when it goes up, this breakout right here, this local breakout, as we've, as I've shown this to you on the previous charts, it's a buyable breakout. So we could buy on the reversal of the test, we could buy the breakout itself. We could also buy any type of sign of strength bar on the way up. And then we would wait for the sign of strength rally, and then we would wait for the backing up action. So these are the conditions for a trade here, just based on the analysis that we have, based on the analysis that this is a potential leadership stock. It's kind of probably the same type of leadership stock as stock number 1 and stock number 2 that we've looked at, not stock number 3, but the first two. Now, the biggest question that I have for you guys about this stock is, what do you guys think? Is this stock going to outperform all other stocks, or at least stock number 1 and stock number 3? We already know that stock number 1 and stock number 2. We already know that stock number 3 is not going to give us a lot of room. And so the only question that we have remaining is, we know that this stock went 77%. This one plus 70, this one plus 60. Again, we are looking more into the structural analysis and comparative strength analysis. These are the first two stocks that are definitely catching our attention. But we said that stock number 4 is bullish long term. It's just very short term. So do you think that stock number 4 could potentially outperform stock number 1 and stock number 2? Okay, and I see some answers coming in, so let's keep it rolling. Let's keep it rolling. So what do you guys think? Okay, so we have 1 no, we have 1 yes. Who else? Give me more answers to work with. Okay, another yes. Okay, guys, I'm pulling out the information out of you today for some reason. Should be very fast and quick. This is just a very simple question. Do you think that the stock number 4 might potentially outperform stock number 1 and stock number 2? So for those of you who have answered yes, why do you think stock number 4 could potentially outperform? Write it down. Okay. Maybe a couple more answers before we go to the solution. Philip is saying bigger volatility hints CO participation, and the length of the trading range may hint bigger move. Now is saying leadership stock in the reaccumulation. Yeah, leadership stock and the reaccumulation. The first two stocks are also in reaccumulation and also leadership. Bigger volatility and hence the CO participation. If anything, it's probably that CO was actually already in this position, maybe got something on the way down, and what do you think CO is doing here? CO is going to be inactive at this point, and this inactivity, that's what brings the price down. So it's not that the CO is extremely active. A point of liquidity for the CO probably was on a change of character rather than somewhere else. And again, remember where CO is buying in the accumulation when the price goes down? Selling climax, automatic rally. These are the first initial spots where CO is extremely active, on the way down, on the way up. And that's what produces a change of behavior, and then that leads to the change of character, to the structural change of character. Think about where CO buys in the reaccumulation. Change of character happens as a profit taken by some institutions. That provides liquidity, and that's where CO will be active. So if CO was active here, maybe here, CO most likely is inactive further down the road. And that's what brings the price to the support level and takes it down. And then the CO becomes active again if this is a true spring at the bottom of phase C. Okay, well, let's look at the result first and then we'll discuss. So this was Lululemon, and indeed this was spring number 2. After that, until the same date, the price went up a staggering 182%. So think about all of these 4 stocks. And at that time of the market history, think about the leadership that these 4 stocks potentially have had. Stock number 3, Research in Motion. This is the stock that has been a leader for years and years before iPhone came out, and then it became a laggard and has been in the downtrend. So the only move here that we could anticipate a swing move, and we don't necessarily want to participate in that. So stock number 3 is just out of the question. We just don't want to do anything unless we are highly speculative, with that position, and we're looking, to trade this stock in general. Stock number 1 was a really good stock for us, Chipotle, and we are definitely would be in this position. And this is the momentum leadership stock at that time. It's on IBD 50 list. You could hear about this stock at different classes, conferences, and so on and so forth. Stock number 2, Priceline, is also a momentum leader of that time. So we definitely would be interested in this stock as well. Stock number 4, Lulu. Is this the momentum leadership stock at that point of time? Yes, absolutely. So a leader as well. So think about how institutions are treating leadership. They always want to be in the leadership stocks. So what happens here with all of them? Okay, so the first stock, we see that the Chipotle does not have a lot of great points for institutions to get into this position. Maybe there is some value after the earnings on the change of character and they get in there. Maybe there is some value in the short-term oversold condition, some short-term weakness, and they get in phase C. Priceline is a different animal. We might have some buying on the way down, like all of this and some of the flash crash, and then we definitely have some buying on the way up, all of that. This is where the buying by institutions is happening. Lululemon is also a leadership stock. So where would they be buying this stock? Well, obviously on the way down, so somewhere here, think maybe somewhere here, and then somewhere here as well. This lowest point right here represents a short-term oversold condition, short-term value, and short-term liquidity. So everything short-term, but I want you to compare this to where the first two stocks are. And if you would be thinking about comparison of, let's say, where we are relative to the previous low, right? So for instance, if we're taking a significant market low, so let's say it's somewhere here, this is the low, and we would compare where the price is relative to that low, this is what we get for Lulu. Then do the same for Priceline. Okay, so this is where we are for Priceline. Okay, do the same for Chipotle, and this is going to be insane. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. So I think this low right here. So this is the low, and this is where we are. Okay, so here's the question, and this is the question that I want you to kind of cement in your head. If we consider all three stocks, CMG, Priceline, and Lulu, are kind of like equal and equal, quote unquote, equal leadership opportunity, then the question that we have here is which stock has more value at this point of time? What do you guys think? If these three stocks are all equal in their leadership momentum characteristics, which stock has more value for institutions at this point of time, thinking about that all three has a bias to the upside? We know that all three are going to go up. All three might potentially outperform the market. But which one out of those three has the most value to the institutions? What do you guys think? Write it down. Yeah, so stock number 4, Lulu. Just because it's so undervalued, it's oversold, it's undervalued, and it has some liquidity right on the point of entry right there. All of those points. But predominantly, it just, again, like think about maybe like 3 stocks that are starting at the same point of price and time. And then stock number 1 does this, stock number 2 does this, and stock number 3 does this. If this next scenario is going to unfold as all of those 3 are still going to go up just because the overall trend is up, then they're going to go for the stock that is going to be undervalued. In their minds, it has more potential if the price still is going to go up. It could have more potential, to go up because they will be evaluating all 3 stocks against each other, all 3 leaderships against each other, and they're going to say that Priceline has extended already off the lows so much, and we got into that position. Chipotle just did not produce a lot of points of entry for us, just because it's such an outperformer. But Lulu had this short-term undervalued spot, and we want to go there because we know that Lulu is definitely going to still be a leadership and it's going to catch up with other stocks. So this percent that Lulu has made, plus 182%, that's just catching up with Priceline and Chipotle, the momentum leadership at that point of time. So a very interesting kind of like point on the way how laggards that are in the leadership groups or for the stock that has leadership momentum characteristics could really quickly come back to that leadership and actually start outperforming. Okay, some questions. But has the Lulu really as strong strength indicators as stock number one? From Philip. Well, Philip, we just went through this, right? So strength on the way up, strength in the trading range, weakness into phase C. So yes, it does have, strong leadership characteristics, uh, as well as stock number one and as well as Priceline on the way up. So all three of them have elements of strength. Doesn't it then mean that we should choose stocks with less intense strength indicators? Because if it does, it obviously advanced more, thus it becomes an interesting to the CO. Okay, let me rephrase the question just for all of us to understand it. So the question is, if the stock has been advancing already so much, wouldn't we be more interested in the in a stock that has strength characteristics and then some short-term weakness? Yes, and that's the whole point of this discussion, Philip. That when you see the leadership stock having short-term underperformance, and you still concluding that the long-term bias is to the upside, this short-term weakness might be just an opportunity for the stock, to rebound from, and we should definitely look into that. Okay, great. We're done with this exercise. So as your graduation homework, you could just go through this by yourself and just kind of browse through this. Okay. Okay, Nilesh is saying, getting into the stock early in phase C, test pays if you are right on the bias. Yeah, and we've talked about the way how we would get into the position. When we're going to have an example of the spring, I'll talk about that a little bit more. Okay, let's talk about Wyckoff Trading Plan Performa. So why do I say Performa? Well, because this is something that you still need to work on your own after the course. And you need to figure out the way how you would like your analysis to flow. It could be a different flow than what I have here. And I've shown to you the process, right? We've talked about the process of selection, where we go and identify the leadership first. We go and do the market analysis first, define what the market is doing. That's number one. Secondly, we go and we define the leadership, whether in this sector or group, and then we go to the stocks level. And only after that, we go into the price structural analysis. Let me bring this example again. A lot of students have asked me a question. Should I do during my weekly selection process, should I do the price structural analysis first? So my quick question to that as a reply goes like this. What's the size of your universe that you look at? Because if you look only, let's say, on a weekly basis at 50 stocks that you follow religiously, then those 50 stocks are not a big deal to go through on the weekly basis once a week. And then maybe even just to look at them once a day. But if you have, let's say, 500 stocks to go through, or maybe a couple of thousands of stocks, or maybe if you're a technical analyst and you go through, let's say, 4,000 to 5,000, or in some cases the whole market of, let's say, 8,000 instruments or so, then it becomes a little bit more difficult. Also, think about that funnel that we have created, that selection funnel, which starts with the market, then goes to the sectors, then goes to the groups, then goes to the stocks, and then we go into the Wyckoff analysis. Think about this as kind of like an easier route to get to the stocks that are most interesting to you. And obviously the way how you can create that scan that brings you to this point, or a filter that brings you to this point, that's going to be really crucial. And this is a subject of its own. But if you have a large number of stocks to look at on a weekly basis, price structural analysis is not going to be the first thing that you want to look at. The first thing you're still going to start with is a market filter. What is the market doing at this point of time? What is the long-term, intermediate, and short-term trends? And I've shown you guys last time as to how we would define that. We would look at the last secular low, which was in 2009, and then from there we would look at the market that we have, right? So 2015, 16, 18, 19, something like that. And we would say that, yes, long term, up, intermediate, trading range, short term, up. And that would be the definition of the market. If we have a trading range, we would do a phase analysis. So we are probably somewhere in phase D if we are bullish. And we could be potentially in phase C, but I just don't even see this, so I'm not even going to talk about this. So we are talking about either phase D, or could we be potentially talking about maybe like phase B, and also does not make sense. So yeah, so the latest rally acts as a sign of strength. It's either a minor sign of strength or a major sign of strength. So in both of those are going to be in phase D. Okay, what are the best trading opportunities right now based on the market context? This is a very important question. Think about this. Each market conditions are going to give us specific opportunities. What was the opportunity off the bottom? It was in the stocks that had a lot of momentum, and in the stocks that maybe had characteristics where the structure has been developed, volatility has increased in October, December period, and the stock was making higher low to the low of the market. So the stock was stronger at this point of time. So even though volatility has increased, but it produced higher low, so indicates stronger stocks, and causality is already done. Finished. These are the stocks that we would be looking for at the bottom, or in January, even early February. These are the stocks. What are the stocks that we would be looking for right now? We are in this formation. So what are the stocks? What are the candidates that we would be looking for? Well, we know that the next move is going to be to the downside. It's just how it is. It's either going to be a meaningful reaction into probably the upsloping resistance, and it's going to develop as kind of like a trading range, or we might potentially have 2016 analog where we go up and then we kind of rest at the top here, and then we go higher. from here. So that's a possibility as well. So think about if we do that in both scenarios, this definitely will be phase C. And then we are definitely in phase D currently. So this type of thinking, current market conditions, what kind of opportunities we have here. So we might have an opportunity to the downside. This is where the bearish sentiment could short-term provide a lot of liquidity, quick moves. So we would be looking for maybe even not necessarily shorten a specific stock, but maybe have some hedge against the market. And that hedge might not be very, substantial, just, to cover some of the losses that we might have within the long-term position. Having said this, any type of reaccumulation pattern right here would suggest that long-term campaign positions could be of interest to us, and we would go and identify those. Okay, so what's next? We understand what the market is, what it's doing, where it is, what kind of opportunities we should be looking at. So then after that, we would start our scanning for outperformance or underperformance. And as we've done this in the previous class, and thank you for your emails. A lot of you emailed and said that, that was really helpful just to go through the process and maybe even to see it, how you do it live, on stock charts and so on and so forth. So it's great. And we would do the same thing. We would either look at the sectors, so maybe we will not look at the sectors. Maybe we'll look into the groups right away. And from the group level, we'll identify those two things that we've talked about last time: leadership and rotation. Then once we have that and we go to the stock level, this is where the watch list first starts to be formulated. Okay, so maybe this watch list is going to have, at the end of it, maybe like 50 stocks, maybe 100 stocks. Those are going to be of interest to you. Okay, so, and by the way, this type of analysis right here should be very quick because it could be optimized. Visually you could be doing this, quite fast. Market is going to take also a quick session for you to go through. Why? Well, because the long-term picture does not change a lot. The intermediate picture does not change a lot. And then the short-term picture you'll be able to analyze pretty quick. So then once you have this 50 to 100 stocks, let's say, then you go into the price structural analysis. This is where you want to be slower and more deliberate in your analysis. And obviously you're looking for the timing. Phase C, phase D. Bias is already going to be somewhat determined, but you would need to double check on that. But you're looking for that timing. Identification of phase C, third test, second point of fear, specific volume signature. Confirmation, the price returns into the trading range and then starts making higher highs, higher lows. Like of events associated with phase C, last point of support, spring or shakeout. And those are obviously bullet points. Behind each statement here, behind each line, there is a system, right, that we've created. How do we identify a second point of fear? Well, we have to find the first one and compare them. How do we identify test number 3? We have to understand phases. How do we identify volume signature? We need to understand how going into phase C, the volume signature must behave, and more preferable behavior of that, and so on and so forth. Phase D, a change of character that is structurally being created by the sign of strength rally and the backing up action. Do we have that? What's the confirmation? A resumption of the uptrend out of the backing up action. Like of events, last point of support, sign of strength bar, sign of strength rally, backing up action. Okay, so we understand the structure right now. And our watch list might actually decrease. So now we might be looking maybe at like 20 to maybe like 50 stocks. The next step is going to be even more deliberate for us. We have to get more detailed because if the goal is to have maybe like 5 positions, then we need to still condense our universe to that number. So we definitely want to look at the supply and demand, volume and price, effort and the result. And there, this is where, in this analysis, this is where we're going to be confirming the bias, we're going to be confirming the timing, and we are going to be confirming the character with which the price is going to move. So if you have 20 stocks and you just do that thorough analysis with 20 stocks, that should take a long time. So this still should be potentially kind of like average time that you're going to spend on this. And this is going to be a lot of time that you will devote. And it's the most important part of your analysis because it's so close to your final selection. And once you do this, then you're probably going to have maybe like 5 to 10 stocks that are going to go to your daily execution watch list. And this is the list that we've talked about last time that you have on a daily basis in front of you. And each day, either before the session starts or maybe right after it starts, and most definitely before the session ends, where a lot of the trading decisions are being made either by institutions or by yourselves. This is when we're going to look into this list and we're going to go through this 5 to 10 stocks really quickly, let's say on stock charts, put the symbol in and look what the price has done. Look what the volume has done. You already have all of those scenarios outlined in your head. So in reality, you don't need a solution at that point of time. You need data to make a correct executional mistake. The correct executional step. You're basically saying, okay, my watch list is saying that if the price is gonna close favorably next day or during the week, and it's gonna show a significant bar that breaks to the upside out of, let's say, a short-term pattern, then I'm gonna buy. So you really don't get emotional when you know that one of the scenarios is going to be like this, and if that happens, then you act. If it doesn't happen, let's say that a stock on your watch list actually fails, well then what you want to do is just first of all take that stock off the list. That's number one. Secondly, put it into the bucket of stocks that you want to follow afterwards, to post analyze them to see where the mistake was. And that post analysis has some kind of well, it's going to have a lot of value for you as you start adjusting your analysis, and that's going to be extremely, extremely helpful. Okay, so then once you have that watch list, what you do next is you start creating your tactics as to different scenarios. And I don't have scenarios here, I should add those. And then secondly, what are your executional tactics, right? Where do you get into the position? And obviously we want to get in on all of the Wyckoff buy points. Sprint number 3, test of sprint number 2 or a shakeout, or a test of the shakeout. Last point of support, sign of strength bar, backing up action, or a breakout out of the backing up action. So all of those are going to be our potential points of entry. Stop loss, original placement, and then the movement, and then the exit. Where would we want to exit this trade. Okay, so that's the pro forma for the trading plan. This is something that I want you to take and to think about and add something of your own. You could take this path, but then let's say in phase C, you might say like, okay, I'm going to add something more to this. I'm going to add maybe that phase C is going to have specific volume characteristics. I'm looking only for phase C that has diminishing supply signature and not increasing supply signature, something like this, and so on and so forth. You might say like, okay, I'm not going to look at the sectors. I'm only going to look at the industry groups and stocks. So make it your own. Look at how you're trading currently, and then think about the ways on how you could potentially adjust this pro forma, to your trading. Okay, well, let's go into a case study. Okay, yeah, I think we're doing okay on time. Okay, case study, Apple, Qs. So we definitely would be thinking about the market here. So this is, or we're discussing the second filter, but in reality, filter number one, the market. So we would be thinking about long-term picture. And this is 2011. So think about the structure of the market where we were. The 2009 low was this secular low. So, and the market went up. So we are in the long-term uptrend. Intermediate trend. What is the intermediate trend at this point, or at any point on this chart? A trading range, like the one that we have right now. And the short term, it just depends on where we look, right? So right here, we would be thinking about what is the last swing. Well, the last swing was to the upside. Was it reversed? Actually, on the last bar, yeah, we see that reversal. So we're expecting some kind of maybe a higher low here with the bullish bias. Okay, so we're done with the market. Next thing that we do is we want to make sure that we are getting the stocks that are going to outperform the market. So looking at this trading range in Apple, we're seeing how a spring with one commitment to the downside reverses and produces the rally that is much, much stronger than the market's rally. The market's rally only comes to the previous high and stops, whereas the previous high for the stock has been taken out and the stock has advanced from that point quite considerably. So a lot of strength on the way up. Is there a strength on the way down on the next reaction? Well, the stock is making a higher low and the market is making a lower low. Definitely the stock is stronger and much stronger. So we are attracted to this pattern. Why? Because there is a sequence of buying on the way up and not selling on the way down. And we see that on this market volatility to the downside, the stock is being bought on the downside as well. Think about the market volatility, what we had just recently in December, January. And then think about the stocks that are outperforming right now. They are usually the stocks that during that market volatility are going to create some kind of short-term oversold condition. But it's going to outperform the market in general. It's going to tell you that outperformance is going to tell you institutions are not heavily selling the stock and they still buying the stock when the opportunity presents itself. Now also think about something else. Think about the way how the CO gets into this position. And this volume signature is actually Qs, so we can't use it for Apple, I believe. Actually, no, this is not true. Looking at the volume signature, most definitely this is not the market's volume signature. This is Apple. Yeah, definitely. This is the volume spike. I remember that volume spike. Okay, so look at how supply comes in. So supply increases, but yet, we're holding on to the higher low. So there is some buying on the way up. We see this from the volume signature. We see the buying on the way down as well. So and that kind of confirms that strength after strength and a sweet spot definition, where institutions are extremely active in this area. And then what do they do next? They just become inactive. They bought into this position, then what do? Oh, we're just gonna go and rest. We're just gonna go and maybe buy something else. We're just not interested in the stock at this point of time. So what does the stock do? It's just there. There's nothing's going on. There's nothing's happening. And then suddenly weak hands might, get it up. Mean reversion trade works out at the top. The market still produces that definition that short-term mean reversion trade should work because we are in the trading range. Look at how mean reversion trades work so nicely. This is a big, well, even from here, nice move, nice move, nice move, nice move, nice move, and again, nice move up to here, nice move here, here, and it's all mean reversion trade until we get into the trend and they start trading mean reversion as a trend, right? So they would be thinking going up and down. So these are the spots in the trend where we gonna sell and where we're gonna buy. That's a whole mean reversion concept. And they would be so successful during this time because it's during the consolidation that mean reversion trade works so nicely. It defines the oversold, overbought conditions almost ideally, just because the price consolidates between the support and the resistance. And usually those type of trading environments, create those opportunities. But, amateur traders do not trade it like that. Amateur traders are usually more directional. They go to the excitement. They go to that's something in the news because we are, as people, are attracted to an information like this. Oh, somebody has made a lot of money in Bitcoin. I should trade Bitcoin. And then when that attention shifts, and by the time you open an account and you start trading, you kind of catch yourself in the last move to the upside. You're excited, and then it just turns on you. So in this case, we see how institutions have bought in on the way up, how they were buying on the way down, then they became inactive. Then they might potentially have bought on the way down again. And then again, they become inactive and nothing is happening after that. CO is inactive. But what it does, all of this buying, there is an absorption on the way up, there is an absorption on the way down, absorption on the way down. So a lot of the supply has been consumed by the CO. And they found the spots where they found both value and liquidity. Those are different ways of how they got there, on the way up and on the way down, but they got there. And then after that, they're like, okay, we have enough of the position. Because we're not going to provide this supply to the markets, the price should not go down considerably. And if it does go below the support, like with Lulu that we see, like a spring, then they're going to be extremely active at this spot because it creates that value again. They're going to buy in. That's going to increase the momentum. All of these systems are going to be triggered. And then the next wave of buying is going to unfold. and it repeats over and over and over again. The market is the collection of visual representations of our behaviors. And as everything in life, we are small and they are big. And by we, I mean retail traders, and by they, I mean institutions. They behave in a specific way. They have certain rules as to how they need to behave. We have, retail traders, when we come to the market, retail traders do not have rules. Retail traders do not have systems. Nothing is built in. So therefore, in general, retail traders' behavior is somewhat predictable, correctable, but predictable. And that's why we are in this class, because we want to correct that behavior. And then institutional behavior is also predictable, just because we know what they need in terms of the value and the liquidity. We know how to identify their steps, their presence on the chart. And therefore, we just want to go with them along for the ride. That's the whole idea. Okay. Okay, so strength, 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 strength again, strength, and then weakness. Again, we are in a situation, and this whole rally is strength. We're in a situation where we have the leadership on the rally, leadership throughout this first half of the trading range, 2/3 of the trading range, and then weakness into potential what? Maybe potential phase C. If this is phase C, then this would be the timing, and it seems like for the market at that time, this is an attempt to spring, failed spring. So potential phase C, sign of strength, backing up action. A little bit too much supply here, so we need some kind of test, which creates an apex, suggests a continuation to the upside. So phase C, so we are in phase D. This is a good point for us to be in the position to buy. Okay, so once we are done with the relative comparative analysis, we go to the next one, price structural analysis. Well, this is a different structure, same stock, different structure. Let's look at how the structure develops. We've talked about this chart. Horizontal structure here after a potential change of character would suggest that we would need to wait for the sign of strength in the backing up action in order for us to open this position. We probably would be too late, so the downsloping structure works much better. Here it is. And then look what happens. A sign of strength actually commits to the upside and has two progressive closes up. And then it comes to the support level and that act before is the resistance and bounces up. So a lot of points of entry right here. I think it would be really hard for us to find the points of entry on the way up, with an exception of the gap day itself, because it's a significant bar day. Look at the true range of that day. And if the day would look like this, and at the end of the day you're going to say, am I a bar here or not? So your answer should be yes. You might wait for some tests within the next 2 days or so and look at the tests. They are not coming down, so you could buy on the tests as well. Still a really good spot here to enter the position. The second entry would be here, the third one here. So that would be the sequence. And then obviously after this, we want to see maybe another bar like this. So this would be point of entry number 4. Okay. Oh, why do I have filter number 2 here? Huh. Yeah, this is not correct. This needs to be corrected. And here as well. Okay, apologies for this. Something is not right. Although we do look at, yeah, so we do look at the both price structural analysis and comparative analysis. So Apple, this is again different time frame, 2001, 2003. A lot of strength as the market still travels down. So that tells us that this is potential leadership in the future. We definitely want to consider this stock, and we need to understand the structure. And the structure is such that going into 2000, late 2002, 2003, we're seeing how the price just stays at the level of the support, doesn't go up, doesn't go down. And it seems like all of the indications of strength that suggested that there is a buying on the way down, there is a buying on the way up, buying on the way down, buy on the way up, buying on the way down. With all of that, they are already in the position. If CO is in the position, what happens here with the CO? CO is inactive. Why is CO inactive? Because the CO has accumulated the position in the stock. That accumulation by the CO has been shown to us, visualized for us on the comparative basis. We see that from the strength on each rally and on each reaction. And then the CO is just saying, I've got this position in my belt, that's it, I don't need anything else. What I'm gonna do though is I'm gonna go to the other stocks and I'm gonna buy those stocks instead of Apple at this time. And that's why the market is starting to go up here, because other stocks are being bought and they are starting to outperform on a relative comparative basis. They are outperforming Apple. And then only when there is some kind of urgency that starts to occur, or maybe a penetration of the support that creates that short-term panic, and the CO is attracted to the stock at that point of time because of the liquidity, only then we would go into this position. Other than that, we're just waiting. We might have some trades, like right here, that are going to be losing trades, a loss. But that doesn't mean that we shouldn't be waiting for the true timing right here. And it's going to be very distinguishable. Okay, let's see what else. Okay, something that I maybe alluded to but have not talked about. Do you guys know that you don't need a lot of the stuff that I taught you throughout this 15 weeks? That you literally can just trade the structure and have just price structural trading rules and be okay. So what are those? Well, usually when somebody studies Wyckoff method, you usually study, let's say, something that was created by the SMI, and you could, let me just go here and show you. So on our website, you could look it up. This is the article under the Wyckoff primer right here. By the way, we have it in Spanish and in Chinese, so if you're interested in those two languages, you could definitely read those. This is the article that was written for the chart school at Stock Charts. They've commissioned us to create this article for them as a part of the content package that we were creating for them. So this is what we wrote. All of the schematics, we've developed ourselves here, and then Stock Charts just took the leadership of that. Yeah, so this is the schematic that I created for them. Interesting that some of this is kind of bringing some of the discussions at this point. Although I don't see anything in the schematic. Yeah, that should be okay. All of them should be okay. Oh yeah, Sign of weakness in phase B. Yeah, but it's a minus sign of weakness. I see. Yeah, interesting. Okay. All right, well, let's look at this. So 9 bind, 9 sell-in tests. Bind tests. Let's go through the bind tests. What do we need to see here? So this was an SMI's attempt to kind of put everything together into some rule-based steps, trading plan, and so on and so forth. So what do we need for the 9 bind tests to materialize? The first test, the downside price objective has been accomplished, and that information you can extract from the P&L. So for instance, if you had a downtrend and then you have what appears to be an accumulation, then you want to make sure that your calculation of the causality, which is distributional causality, comes as a target into the area where the new trading range is being formed. So that's our test number one. It just basically gives you an idea that the target has been reached and that we are done with this downtrend. Then you want to look for the evidence of that completion and the evidence of the climactic run in phase A. Right? So we are looking for preliminary support, sell-in climax, automatic rally secondary test. So that's number one. Number two, then we're looking for bullish activity, volume increases on rallies and volume decreasing on the reactions. So what this describes effectively is a change of behavior, not a change of character. Downward stride broken, so we want to see this break. So and number three is going to be somewhere in phase B, and then the break of the trend right here, number four. Number five and number six, higher highs, higher lows. So this one could be in different positions, and this is where I'm kind of realizing myself, as I go through those and as I'm preparing sessions, for students, that I can't use all of those. Some of them, they do make sense, but there are so many variations on how it could happen. It cannot be universally true. We could have higher highs, higher lows in phase B, but it doesn't mean that this is the timing to get into the position. So I'm usually kind of like not using those. But you could think of it as maybe like a sign of strength backing up action where you have a higher high and higher low. So that type of thinking, could be beneficial. Number seven, stock is stronger than the market. Okay, well, we just went through the comparative relative analysis. And then base forming, which is basically a causality. We want to understand that there is sufficient causality. And one of the thoughts about the causality that I have, guys, is why do you need the big causality? What's the understanding on our part of the causality? What do you guys think? Why do you need, why bigger cause is better? Can you answer this question? Can you write down your answers? So, and I'm going to answer right away. So, the bigger the cause, the larger the effect. Okay, so that's going to be the most common answer to this question. What else could we possibly be looking for in the bigger, larger formation? Now, let's just say sufficient absorption of supply by strong hands. And that's so true. Think about two examples of causality. Two examples of cause. This and this. One is small, one is big. So think about supply. If supply is the same, so let's say supply 0 and supply 0 here are is the same level of supply, then think about how quickly all of this supply needs to be absorbed by the CO in order to push the price up. Could it be done? Maybe it cannot be done. Maybe that absorption is just going to be partial absorption. Whereas in this case, there might be more complete absorption of the supply by the CO. And if there is more absorption, more complete absorption of the supply, then what should it bring us to? Better trend, better sustainable trend. And this is something, those small nuances like this, right? Where concept that is so conventional concept, yeah, the bigger the cause, the bigger the upside, the bigger the effect. You kind of have to think about these concepts from a different perspective. We're in a lot of ways we're taught to be thinking about the outcome itself, right? The bigger the cause, the bigger the result. But if we would look into more the underlying reasons of why would the trend be bigger? In reality, it's all about the behavior by the CO, by the institutional type of the CO. If they have more time to absorb the supply, it might take more time for the price to fluctuate in the trading range. But essentially, at the end of such accumulation, in the institutions, the CO will have a much larger holding, and therefore, if they're going to hold on to this, that supply is not going to be presented to the market for quite some time, and is going to confirm, the sustainability of that trend. And also, that's going to influence the character of the trend as well. The way how reactions are going to develop, the way how stepping stone trading ranges are going to develop, and so on and so forth. So there are quite a few things that we need to think through more thoroughly, rather than rely on more like conventional statements like, yeah, the larger the cause, the bigger the effect. That's understandable. Okay, number 9. Estimated profit potential. Again, we're talking about the causality, so we could estimate that. So cause, number 9. Base forming, number 8. Stock is stronger, somewhere here, strength, number 7. And so on and so forth. So number 5 and number 6. Okay, so here's this whole plan. That they wanted, their students to have, and by them I mean SMI. And obviously, it has become a part of the methodology. This is not my favorite part. I do not teach that, but I've extracted maybe kind of like the best practices here, just based on the price structural analysis, the way how the price unfolds. So look at this. Test number one, 3 tests that you have to go through, structural tests, and you can trade without the volume signature whatsoever. You can trade also without indication of the relative and comparative strength if you don't care about the performance. If you just care about the bias, that's what you can do. Break of the trend, test number one. Test number two, major sign of strength. And this is something that you will have to be able to identify or to learn how to do this. It's the rally of the lows in phase C that travels through the whole trading range, overcomes the resistance cluster that was created by the highs in phases A and B, that commits progressively to the upside and allows the price to stay above the resistance cluster and then pulls backs up exactly to that cluster and then resumes the previous trend, which is to the upside. That's the definition of the sign of strength. Characteristics of the sign of strength: increasing spread, increasing volume signature. Those are characteristics. Those are not definitional traits. Okay, so let's come back here. Test number two, a major sign of strength. So kind of easy in our case because we still have test number three. So it's not like we're gonna come in on a sign of strength rally and open the position. A good example of this concept and how it could fail could be this rally right here in October, November. There is a close above the resistance, and then there is a failure back into the trading range, and then a second failure, a breakout below the local trading range that we see here. So what we need to see from the major sign of strength and then subsequent backing up action is an ability not only to commit to the upside, but to commit in the specific way, to have the ability to stay above that, and see how different this upthrust and this sign of strength are. In the sign of strength, the price stays up for a lot of time above the resistance. In the upthrust, the price goes up, stays there a little bit for a couple of days, and then falls back. It just can't stay there because sellers are attracted to this price and they want to sell as fast as they can. Here, there are fewer sellers, and if there are some, there is some absorption even at this higher level. So what we need to see in the backing up action is the ability to pull back and then resume the uptrend. And that would be test number three. And see how easy it is with just the price structural trade rules. Break of the trend, we are done with the downtrend. Then we're going through the trading range and we're kind of like not interested until the point of the rally. Until the point of the rally. And then we're saying, well, obviously we need to have a proper backing up action after that. Failure, not failure. And we need to wait for a reversed reaction, a reversal here in the backing up action. That's when we are coming in, and that's a high probability point of entry for us. And you could just trade that. I mean, think about how valuable that is as one idea that you could trade over and over and over and over again. And there are so many stocks that are always going to be at the spot, either to the upside or to the downside. You don't need phase C. Phase C is something for maybe more advanced students that are going to be determined to initiate a pro position in phase C. If you don't have time for this, look for the characteristics of the sign of strength and the backing up action and trade that. And believe me, your rate of return is going to be, not the rate of return, your win to loss ratio is going to be so favorable. because in a lot of cases, when you are buying in phase C, you will be faced with a situation where you will have to close a position just because it was a short-term reaccumulation type of texture that brought you a short-term bias to the upside. You got into this position and then it reversed and it failed around the resistance because supply still came in and you have to close. So if you're willing to go through this type of trades, which I do, and I could show you some of those, I'm okay with this type of trading, but in my case, I'm doing this, each day. So for those of you who don't have time, the best high probability spot is always going to be after the backing up action. And if you think about where the backing up action happens relative to the whole trend, you might be saying like, oh my gosh, the stock went up like 20 to 50% up into the backing up action. Do you know how valuable that is as a sign that the stock can travel so much and now it's in the consolidation and might continue its move to the upside? You might be actually, before the distribution, you might be just experiencing the first 10% of the move, or maybe even 5% of the move. And you still have so much ahead of you. But think about where you're coming in. A high probability identification point of entry. So think about that type of strategy. Okay, what's next? Quarter to 5. Okay, we've talked about the effort and the result. Yeah, so different characteristics, how absorption happens, how supply levels are behaving. So in this case, in 2008, 2009, Apple, we're seeing a lot of accumulation on the way down and in phase A. Just a lot of buying. And then, so all of this, buy, 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 buy on the way up, buy on the way down, buy on the test, buy on the way up, buy on the way down. And then some occasional buying like this one, this one, this one, then this one right here. Then there is smaller buying. We see this from the consistency of the demand. Let me just put everything on the chart. Okay, this. I think this, this, this. So look at how the value zone is being constructed. This is the value zone, institutional value zone. And they are buying at all of those spots, but the most aggressive buying is obviously in phase A and early phase B. So supply is always crucial because it gives us an understanding of what CO actually is doing. If supply is still available, our question is CO absorbing that supply or CO is inactive? If CO is inactive, most likely we're going to have the continuation to the downside. If CO is actively absorbing, then not only we might have accumulation bias coming out of this formation, we also might have some kind of leadership characteristics. I mean, the way how the CO was buying this stock at this time, and think about in 2009 what the stock represents at that time. This is the hottest stock in the market. It still has in the pipeline so many products that are going to come out within the next 5 years or so. The cash, the revenues just are being accumulated at the very fast pace. So obviously, there is a lot of value on the way down, and there is a lot of liquidity. And we see that both from the way how the downtrend has developed and also from the way how the volume signature behaves. So therefore, the most aggressive buying is going to be at that spot. They don't mind going through the consolidation, and it's not our goal to go through the consolidation. Our goal is to understand the motives behind the composite operator behaviors and identify the timing when that motive is going to become more of the reality, where the trend is going to start to emerge. And that obviously happens in phases C and D in this zone right here. Okay, well, that's the supply. What about the demand? Well, in a lot of cases, demand is going to show up as an demand either on the way down or urgent demand on the way up. And that urgency, again, defines the timing for us. This is the stock that has a lot of interest by institutions. So, and that interest is now. It's not on the way down where it is, but the timing is not there. It's not necessarily maybe like on no volume type of rallies that we have. We don't see that institutional urgency. But when you see something like this, where the price just goes up so quickly and the volume signature is so high, and you might be thinking, yes, supply is there. Absolutely, supply is there. It just, what happens afterwards? What is the test? And the test is that we're still going up. So that suggests a bias to the upside. There are more buyers, and obviously there's still institutional buyers on this second bar that are still coming in and buying. So there is no test after the first bar. There are still some buyers even after the second big bar, and they're still buying on the way up. Less so, there are fewer of them, but still there are some buyers. They are late buyers, but they're confirming the overall bias. So that type of demand we definitely need to identify and to see that as a timing tool and also as a potential leadership tool. When we think about this urgent demand, we always say timing, but think about why. What is the reason for this urgency? And such a huge size to be in this position. Well, most likely they know something that we don't, and they're, looking at this stock as a potential leadership for quite some time. So that's what's happening. All right, guys. Homework. Again, homework is going to be optional. That's number one. Secondly, this is going to be for the practicum students. But even those of you who are not going to take the practicum, I would really, really highly recommend that you do this homework. It's a final homework that I usually have, in between two courses, just because there is some window there before the next course starts. So we want to use that. But it's a very useful exercise. All of the students who have done this exercise, they kind of felt the practicality of all of the concepts that we've talked about. And that's a very important feeling that you have to gain in order for you to feel more confident with the methodology and how you apply it in your trading. So what is the homework? Okay, so the assignment is just to use Biogen or any other stock, I really don't care, to backtest the Wyckoff trading plan. So what you do is you go to the Proforma plan and you start applying all of the filters and all of the execution steps one by one with all of the trading ranges that you can find in Biogen. And then as you identify a trade, then you put it into some kind of spreadsheet where you have the number of trades, what was the pattern, trade date, what was the price, what was the original stop loss, how did the stop loss worked out, what was the gain and the loss, and when did you exit this position. The question usually comes here is, could we use a hypothetical portfolio? Yeah, go ahead. Use maybe like 100K, and you could just have another like P&L here column, and just create that. Or don't use that. Just identify the gains and losses in terms of the points that you collect. That's the simplest way. I don't want to overcomplicate the stats that you're collecting. But definitely mention, the market direction, analysis of the comparative relative outperformance, your labeling, so you have to label each of the trading range where you originate the trade, your points of entry, stop loss, and where you exited. So, and I want you to have these stats, and also I want you to have charts. Charts with what? With some kind of trades that you've originated, and you're showing those trades on that chart. Maybe you're showing some trades that have failed, and maybe you're showing this losing trade. That's also quite acceptable and needed for us to understand how you did this work. Philip is asking, so go candle by candle, analyze like that? You could do that, but even at this point, and I've asked you guys to kind of trust me with this education, and we are at the last session, so we can talk about this, more freely. Okay, so here is the whole history of Biogen. So how can you do this? You obviously, would know the history of the stock, but it doesn't really matter. What matters is, through this work, I want you to create a convincer strategy, a mental convincer strategy, by going through all of the possible trading ranges, whether they are on the daily, weekly, or monthly basis, and then originating the trades in those, in those trading ranges, looking for finding the way how the trade would be originated, and as you do that, put in some notes around all of this concept. So let me just do the first one, and then I'll leave the rest to you. So for instance, I'm looking at the first trading range right here in 94, 95. Obviously, I will have to do what? First, I will have to look at the market. Secondly, I'll have to see, is there any comparative strength at this point of time that I could identify, and where would it occur? So maybe it wouldn't occur here. Maybe it would occur on the sign of strength instead. And we see how the momentum actually plays out so nicely here, suggesting that institutions are finally buying. So my points of entry might be after that and not necessarily before. It all depends on where the comparative strength came. And I'm not that familiar with that particular region of the stock price. Okay, so after that, we are in the backing up action. How do we buy it? We buy it on the reversal, we buy it on the breakout. These are the 2 points of entry for us. And then we are just staying in the trend until what? Until some kind of buying climax conditions, probably somewhere here on this volume spike and on this clearly overbought condition that we see. So this could be our point of exit, at least a first one. So let's say that we have 2 positions, so exit number 1. Exit number 2, we would be looking for some kind of change of character, and then it's a secondary test. Well, we're seeing here a smaller trading range and then the up thrust, so we still would be in this position until probably either this point or this point right here. So this is our exit, this is our exit. Okay, so exit number 2, exit number 3. And then just create a table where you have, all of those dates for entries, so point of entry, stop loss, exit, P&L, and so on and so forth. And just conduct those trades like this, don't overcomplicate this. Take this information, put it in, take this information, put it in, calculate the P&L, that's your job. But you have to do this in a very qualitative way. You have to label the trading range. You have to think about the market. You have to think about the comparative strength. Then you have to think about tactics. Where do you go in? Where do you go out? And then you need records. And that's your homework. The goal is not necessarily to know what's coming, and to define that bias. If that would be the goal, I would give you the exercise where you don't know what stock that is. You already know what stock that is. What else can you do? Well, you can do what Philip has suggested, and you can say, okay, well, for instance, in this trading range, I see a lot of activity, and let's say maybe somewhere here, start analyzing the trading range. What do we see here? Well, we're seeing a climactic action that resolved in another run here. Then we're seeing a change of character maybe, and so on and so forth. I don't want to do this all for you. And then you could, as Philip suggested, go bar by bar. And stock charts can allow you to do this. Look at how I'm doing this right now, bar by bar. And you can define your points of entry. This would be really good, right? Like, what do you do here on this bar? How do you react to that? So this type of situations you can't foresee, even if you know that the price is going to go up. I mean, what's your rationale? What's your logic here of staying in the position? You have to think this through. And that's why this exercise is so valuable when you go bar by bar. But if you don't have time to do that, then just do it in the way how we did this in the classroom. Okay. So that's that. Questions, comments about the homework? 5 o'clock. Okay, great. So we have 30 minutes. Looking at the market for each trade, Philip is asking, well, you kind of have to go through the trading plan, right? So each time you initiate a trade, what do? You compare your analysis to your trading plan, right? Because you don't want to create the variance between your execution and your actual rules. So therefore, market is part of, deciding what kind of trade is available, and going in the direction with the market. So yes, this is the first step always. All right, well, today is the last session, and we don't have a lot of questions. Usually we would have so many questions, like the whole class would be devoted to those questions. So I think maybe because we were addressing those questions throughout all of the sessions, and it kind of allowed us not to accumulate a lot of questions. So I think that, next 30 minutes we could actually do all of that. Okay, 3 questions here. First one is from Abdulaziz. Redistribution schematic. So I think in the last class we've talked about this, but I don't have a redistribution schematics per se, like drawn, but I will draw this to you. And the biggest question is about labeling. How do we label this? Okay, so let's start with the distributional labeling. Buy and climax, automatic reaction, secondary test, phase A, defines the trading range. Phase B, upthrust after distribution, and C with the test, which is LPSY, last point of supply, sign of weakness, which is a major sign of weakness, LPSY rally, move to the downside. So now here we are going into the redistribution. How would we label that? Sell-in climax. And this is going to be in the redistribution intermediate sell-in climax, so it's not terminal. Automatic rally, secondary test, phase A. Definition of the range. Phase B, upthrust after distribution or LPSY, major sign of weakness, LPSY, continuation to the downside. Now let's look at the accumulation. Because this is accumulation, this is going to be terminal sell-in climax, automatic rally, secondary test, definition of phase A, and definition of the non-trending environment. Phase C in the accumulation. All of the definitions and so on and so forth. So what's the difference here, for the redistribution? We are going to have the intermediate sell-in climax instead of the terminal sell-in climax, but then the rest is going to be somewhat the same. The start of the trading range is going to be labeled the same way as an accumulation. We're going to have a change of character in the automatic rally, secondary test as the test, local test of the climactic action. We're going to go through phase B. We're still going to have upthrust there. We're still going to have secondary tests at the level of the support. We're still going to have minor sign of weaknesses at the level of the support as well. And then upthrust or LPSY, major sign of weakness, something that is common for the distribution as well. And then off we go to the downside. So that's the only thing that we could potentially have as our labeling. Now, having said this, there might be some other variations as to how redistribution could happen. We could have something like this, where the price maybe like slopes to the upside like this, and then goes down, and then continues to the downside. So those type of structural differences are definitely gonna exist, but the label in itself still gonna remain the same, right? Phase C, phase B, phase D. And that's the key, is that conceptually we're still gonna be doing the same thing, but there's gonna be quite a few variations on the theme. Okay, let's go to the next question. Okay, this one comes from Philip. As a beginner trader, how do I start? If I want to use 1% risk rule, then from the prices of the stock, it looks like I would have to put around 10,000 in my account. Is this the only way, or how should I approach this problem? So the key in this question, Philip, is this: how should I approach this problem? So one of the things that I really, really want to you to think about, especially as you're a beginner, is to create some kind of practice that leads to consistent results. And Philip, I'm not joking here at all. This is actually, you and I would get into the private session. This is exactly what I would tell you. If you're a beginner, don't put the money, into trading right away. The first step is still going to be to practice to the point where you have consistent results. What are the consistent results? Well, for instance, you do some simulation, and then let's say maybe your goal on the simulator go through at least, let's say, 100 trades. And if your results are showing that, let's say, more than 50% results are winners, then proceed to the next step. If not, practice more. And until you get to that level where on the simulator you can identify the bias correctly, you can identify the timing of the trade, you can enter the trade correctly and then execute the trade correctly, and 50% of the time you're making money, then definitely go to the next step. So Philip is asking, simulation means something as our current homework or a practice account. You could use both, either. There are quite a few simulators that you could purchase as a software. I actually use a couple. You could just even use the stock charts, the one like I've showed you, candle by candle, as you said, right? So that's so useful. Sometimes what I do is, let's say, my wife would watch, some kind of show, and then I would be just kind of using my iPad and leisurely, as I watch the show, but leisurely just concentrate on the chart as well and go bar by bar. And I'm just kind of going through the thinking process of how do I analyze, how do I enter, how do I react to those gap days, and so on and so forth. So any type of simulators that you could use, those are useful. Even if you know the history of the stock, you don't know bar by bar what's going to happen. Second step, once you're done with the first one, second step is going to be put a limited amount into your account. And then use the smallest size. For your initial trading. So for instance, if your ultimate goal is to use, let's say, 3% risk per position, then I want you to divide this into, let's say, different portions. So maybe like a quarter, or maybe even less so, maybe like 20% of this 3% risk per position, right? So what would it be? For instance, 0.6%, maybe like, to be better, like 0.5% of equity. So this is your 0.5% of equity per position that you want to use. And then just work with this and show again to yourself that in a 3 to 6 months period, you can produce consistent results. If you do this, then go to step number 3 and then trade full size. Now there is a step number 0 to that. Right? So step number 0, knowledge. Skill. And obviously I'm putting the semantics here for our products, but you could use any other products. And, you know, if you could go through this as a process, I think it's going to be very valuable. Knowledge, skill, execution. Execution are going to be all of those steps. So step number 1 to 3. And then mental execution. So mental execution, I would not worry for now. This is something that is going to be required after the technical portion of your trading is unconscious. And when you are not thinking about your analysis too much and it just happens naturally, a lot of the bad behaviors that you have in trading and in life in general are going to become more visible, because they will become the single point of frustration, distraction, losses, poor execution, and so on and so forth. And you will be kind of screaming inside saying that I got to deal with this because my analysis is good. I went through all of the drill skills. I've shown myself that I could produce consistently, and then the mental portion of the execution is the only thing that takes me down. So then come to me and I'll give you a different scenario, different plan as to how to work with your mental behaviors. Okay. So it's a process, right? I don't want you to jump right away into this and experience some losses. Build up your confidence gradually. Don't allow yourself to kind of like jump into the water and then have a kind of negative emotional experience and then decide to like quit Wyckoff, quit thinking about your financial independence and so on and so forth. Okay, next question is somewhat, I think, no, something different. I have been swing trading stocks and I realized that the more I trade, the more mistakes I make. Okay, so right away we see some mental landscape from Young here. Therefore, I'm thinking of swing trade for a longer period of time to reduce my frequency of trades. By the way, both kind of like do not have anything to do with each other, those two statements. You can still make mistakes in your swing trading based on your analysis and not on the frequency of trades. But I could see the logic here, because usually when you go to a longer time frame, you are dealing with fewer trades that you have to conduct. If you're dealing with fewer trades, therefore you're going to reduce the number of mistakes that you make. But having said this, Young, I still would concentrate a little bit of the more I trade, the more mistakes I make. So what are those mistakes? This is the more interesting question to me, not in terms of the time frame. What are the typical mistakes that you do in your swing trading currently? And the reason why I want to know this is because you go to a longer time frame, you might be making the same mistakes. And the example of this could be, theoretically, for instance, you make your analysis, you define the bias, and then maybe the bias was defined incorrectly. You get into the position, the stock moves against you, you don't close the position, and then you lose money. That's kind of like a very amateuristic mistake that you could make still, right? So defining the scope of mistakes is extremely important at this point of time. We need to understand what mistakes Young is making. I would like to know if there is a systematic way, methodology of screening for a winning stock that has been chosen by the CEO so that I could get in early in phase C and D and follow the trails of the CEO. Also, since it is a swing trade for weeks and months, how do I handle the trade when the winning stock is in and out of sector rotation? In short, how do I detect a stock early from thousands of stocks in universe that is under the campaign of the CEO and swing trade this stock with the WTC class knowledge and is able to handle it when the stock is in and out of rotation? Okay, so we are 15 after. I think we still have time. Okay, I'm gonna show you an example. Okay. Actually, let me just show you this. Look at this stock. What do you guys see? Let me just put the price here of the S&P. Okay, let's increase the size. Okay, here we are. Xilinx, semiconducting stock. As we go through a downtrend, short-term downtrend in the market, and then we start to recover, right? So we're thinking sign of weakness or a shakeout. This is the bar that changes that perspective, right? So we know at this bar that we overcame a shakeout, there was a test, and now we have a breakout, which is the local breakout right here. So let's say that this is the day when we're gonna look at stocks. Okay, I'm thinking, let me just decrease the size here and just increase the, yes, great. Okay, so what is this date? January 4th. So on January 4th, we're gonna go through our market and then look, January 4th was Friday, January 7th is Monday. So you have the weekend here to make that decision about what you're gonna do. So you're thinking this way, sign of weakness or a shakeout? Well, maybe I don't know at this point. Maybe I don't have that strong conviction level. So what do? Well, still, you recognize that this is an oversold condition. And even in the rally that we might have, let's say a bear rally, that might come to this point, then do this, something like this. During this time, there will be some stocks that will outperform. So you want to find them. How do you find them? Well, you're looking for the strength. That's number one. You look for the causality. And then you want to look at the supply and demand. And you want to look at the structure, obviously. Okay, so Xilinx is some of the one of the stocks that was at this spot definitely outperforming the market, right? So look at how it's outperforming. From this low, we have the stock that is maybe slightly outperforming, definitely outperforming on the way down. Look at how the market creates a lower low. The stock is creating a high low, so that's a strength. So that's already a sweet spot. Then again outperforms during the time when the market is just consolidating. And then look at the reaction, another higher low, another point of strength, another sweet spot. So what do institutions do? They accumulate on the way up. They don't want to sell on the way down. they want to buy on the way down. So therefore, on this day, January 4th, this is the stock that is going to go into our watch list based on what? Based on the structure, which I discussed this. Causality. Is there enough causality here for a swing trade? Yeah, absolutely. I mean, like, look at this 1 year course. So this is definitely something that would go on up for quite some time. Okay, so it's great. Supply and demand. Well, we see how supply is diminishing into the reactions. I'm not going to go through this whole analysis, so you can do this by yourself. Check. Structure. Well, we're thinking that probably phase, and look at the apex formation. So phase C is probably somewhere here, minor sign of strength, major sign of strength. LPS, I'm sorry, and then a backing up action. And we are in phase D here. If we're in phase D, what's going to come next? E. Structure is there. So we are making a bet here that the market might have both scenarios, both bearish and bullish scenario. And we want to pick up the stock that is showing that relative comparative outperformance, and we want to make sure that the stock has causality, that it has the appropriate structure and the timing is now, and that it has that supply-demand signature that is favorable for not just the buys, not just the timing, but also the way how the stock is going to be perform after that. And we have all of those. And that's your swing strategy. So how do you find those stocks? Well, we went through this in the last class, right? So I've shown to you guys how, like on stock charts, I might use, for instance, scooters. I might use, so especially top up, right? So, okay, look at this stock. Look at this stock. Let me just find maybe just one that I like. Okay, so let's look at this one. Look at this stock. What is this? Entertainment. Viacom. Okay. Look at the attempts to stop right away. I look at the structure. This is the latest structure. And it seems like whenever the price went down, it recovered really quickly. Went down, recovered really quickly. What is it? Those are elements of buying, right? Even here, went down, recovered really quickly. So the value zone somewhere here, and I'm just doing the analysis, right? There is a momentum buying here, so that's all great. We just overcame the center line here, that's also great. There's not a lot of supply here, that's also awesome. A lot of it was here, now there is nothing. And then we are having higher highs, higher lows, most likely in phase D already. You could extend C like this. And then it's all about tactics. Where is the point of entry? And this is more maybe of the campaign stock because it might go up and going to consolidate for some time like it did here. That could be a possibility. So Xilinx was a much better candidate because it was already in the reaccumulation zone, and you can define a lot of the, swing characteristics like this. One of the things that I want to ask you to do for those of you, and you don't care, I'm just kind of like asking. We have quite a lot of on-demand products. So, and one of them is actually swing trading using the Wyckoff method, which I've conducted multiple times. Usually in December, I either do a workshop on a swing workshop or intraday workshop. This year workshop is going to be slightly different. Last year I've combined both intraday and swing. This one is going to be somewhat different. And you could just purchase this. This is like 7.5 hours of material, and we go through all of those things in more detailed way. All right, let's go to the next question. Okay, this one is from Doug, and this is just based on the homework that we had. The question here on slide number 5, stock number 2. Last slide, market bar is up. How do you determine if the trading range is sloping or horizontal? Using the horizontal range, it seems to indicate we are in phase D, while using the upsloping trading range, price has stayed within the range and indicates on the right side a possible phase C is forming. Differentiating the two scenarios determine if the stock is in the sweet spot to enter a trade. Okay, so let's just address the question of this. How do we determine if the trading range is upsloping or horizontal? Okay, so I was thinking a lot about this question. And the reason why is because usually it's kind of hard sometimes to define that slope. In some instances, I see that students would just be looking at uptrend and then they would label it like this, like sell-in climax, automatic rally, secondary test, upthrust, secondary test, and then some kind of upthrust here. No, no, no. This is not how we're going to do this. First of all, there should be some kind of understanding of the slope, right? That's going to happen. So for instance, if you're going to have like 45-degree slope, then most likely it's an uptrend. It's not a consolidation. But if you have a less than 45-degree slope, then this could produce a question: do we have an upsloping structure? The second and more important way of how we should be looking at the upsloping or downsloping trading ranges is that every time we have a higher high, and by the way, I should have put here another high here. So this was the actual buying climax. So if we have a higher high and then the price comes back into the trading range significantly, meaning that it retraces a significant portion of the previous reaction. It retraces a significant portion of the previous reaction. It retraces a significant portion of the previous reaction. Then we are still in the trading range, because the action here is for the price is to come back to almost the level of the support that was defined before. And therefore, we are still in the trading range. How to define upslope, slope and trading range. Okay. So that kind of is becoming the key for me in the way how I explain this concept. And Doug, hopefully, that's helpful. And for now, this is the only thing that I can tell you. So those two things. You have to look at well, actually 3. So first, degree of the slope. Secondly, there should be, a similar texture as to the price and the volume characteristics, right? So when we look at all of this, moves up, reactions, moves up, reaction, they kind of look the same, right? So it's not necessarily a different type of price action. It's the same. We could see in the market here, one price texture where the price goes up, where the upspread is increasing, and then a completely different price and volume structure and texture, when it goes into the trading range. So we want to capture that similarity in the texture. And then the third one, obviously, is that, how does the price comes back, the actual structure. So those are the 3 things that I can think about at this point of time, Doug. I don't think that at this time I can, bring you something else on this. Okay. Okay, and a question, I think 3 questions from Lee. Okay, and then there are a couple of questions here that you guys have, so I'll try to address all of those. Okay, 5:30. Okay, so what do we have here? Question number 1. On 11th, March 11th, time stop loss was mentioned, the time stop loss for Apple is about 2 to 2.5 months. Okay, I'm not sure what it means. Okay, so maybe this time stop loss. Okay, what I meant by that, okay, let me just finish the question. However, there are stocks in the trading range which are as long as few years, like Celgene. If we had entered the position early in the trading range, green line, in phase B of Celgene, so let's say here, shall we exit those positions within 3 months? Is there any guideline or rule of thumb for the time stop loss? Two different ways of how we look at the stop losses. So one of the things that we discuss in the practicum class, and this is going to be a big portion, we're probably going to spend like 3 sessions just on stop losses. And we're going to talk about the price stop loss, we're going to talk about the time stop loss, and we're going to talk about volatility stop loss. And those are 3 different stop losses. And we're going to work with all of them. And the time stop loss is just basically going to define for us not the time when we get out if the position does not go our way, but it's going to define more of the kind of like the levels of where the stop loss is going to be based on. So for instance, the price stop loss could be at one support level, and then the time stop loss is going to be at the low stop loss, at the lower price level. So if the price just violates the price stop loss and then recovers, we do not close this position. But if the price, let's say, commits below the time stop loss, we would call this a catastrophic stop loss like Wyckoff did, and we would get out of the position. This will become more clear during the practicum, but I think what Lee, you're referring here is more of the stop loss rule, where in a lot of cases, for instance, if you got into the position right here, and then the price does not go your way, you close out this position. And you use time as a factor, as the timing to get out of this position because it's not working out. So that's just a technique. That's not necessarily the stop loss, time stop loss by itself, but it's just a technique where a time used as the point at which you're saying, okay, I'm closing that position. And this is a good example of how we might be just like using that, but it's a bad example here with Celgene because if we would be thinking about the structure, we would be thinking that this is probably a secondary test in B, and therefore we would know that the price is still going to consolidate for some time. Okay, well, Lee, hopefully that's understandable. Okay, second question. In Celgene graph, assuming we had entered the position in phase C of the green line of the trading range, shall we exit our position at the close of bar number 1? Based on your teaching in previous classes, we shall exit at bar number 1 if we consider the black line trading range. It might be an upthrust or down, and the down bar number 1 is kind of significant bar, and reopen position at point number 2 and point number 3. Other points of entry chances between P and 1 are ignored in this case. Will there be any reasons not to exit the position at bar number 1 as it's already in E for green line? Okay, yeah, definitely there would be some reasons not to close out this position, right? So what do we think here? We're thinking that this is a secondary test in phase B, and then we're going to have a retest of the high in phase B again. And then after that, and in this case, this is an attempt to go up. It does not upthrust. It's upthrust only in the local trading range. And then after that, we should go and find phase C. So phase C here is more horizontal phase C. It's just a variation on phase C. So if we open the position right here, then we should experience a major sign of strength and the backing up action. If we are long-term investors, opening the position in phase C does not, and with the characteristics, of the major sign of strength, we do not have to close that position. We only gonna close this position on bar number 1 if we are swing traders. So this is the swing trade. Close your position. If we are in the long-term trade, then we hold this position. And then we add more to the long-term position. And then we, as you describe it here, Lee, we open new positions for a swing position. And that's how we should approach this. Because for a swing trader, the key is going to be to capture the major swing. The swing between phase C and the major sign of strength is going to be exactly that. It's that rally. The next swing trade is going to be after the backing up action into like the next swing. So therefore, your exit on bar number 1 for a swing trade is perfectly fine. You have all of the characteristics to exit it, especially above the resistance. And you can re-enter that swing again. If you're a long-term trader, then there is no reason to exit. You can scale out a little bit. You can decrease your size, your risk, but not necessary. Okay. Ooh, 2 more questions. Okay, well, let's see if we could cover this really quick. Question number 3. Why don't we open a position at the close of bar number 3? Okay, right here. Oh, right here. This is the bar. Okay. Even if it did commit above bar number 1, number 2, we would be able to get into the position as the bar after bar number 3 did go up slightly higher and so on and so forth. Okay, yes, I would agree here. So I probably have not noticed this bar just because of how the chart is. But yes, you're right. There is a reversal right here. That would be your entry, and this would be your stop loss. You still would be in this position, and you would be able to add to the position right here. Yeah, so a good catch. I just did not see it. And number 4, if I remember correctly, you did mention before there is a tool that we can allow us to know more accurate information about the supply and demand instead of deducing what the volume bar, which is quite misleading sometimes. Is there such a tool? Could you please introduce the tool to us? I probably and I don't remember exactly in which context we mentioned this, but I probably was talking about the up and down volume. So, and this is something that I'll have to show you in the practical. In the practical, we'll talk about horizontal volume. And by the way, I'm arranging for a special, maybe in June, July, for us to go through on horizontal volume signature or on market profile. But I do talk about that in the practicum, so we're just I'll show you example there. Okay, so I think that's it. There are a couple more questions that I'll address and then we'll stop. One comes from Sarah Way. You mentioned that in the price gap up or down, CO is actually buying or selling stocks overnight. Would the volume generated during the overnights be reflected? The quick answer to that, Sarah Way, is no. Would it affect our volume analysis if the overnight volume is not recorded? Yes and no, because we still would be aware that there was the volume signature that overnight that drove us to this gap. And I'll show you on the example. And that's what we have to be aware about, that there was some buying, institutional buying overnight. And then we will be making a judgment of the daily spread and the volume signature for that daily spread. And that's where what our analysis predominantly will be based on. Okay, let me just then find it on a chart for you. Okay, so here is this gap. Actually, multiple gaps here. Great. Okay, so overnight gap. So here it is. What do you think is happening in this overnight gap? So institutions are selling, right? Maybe there are some news. There's some news that came out. What do you think is happening in this gap? Yeah, so they're selling, and that's how the price moves. Now, we don't know that volume signature in the gap. We can extract it, by the way. You can go and find the softwares, like for instance, TradingView. Actually, I use TradingView, so I could look at the aftermarket data on TradingView. So you could look at how the price moved. You could look at the volume signature. Now, is this going to be a really good identification of the bias? Well, your bias is going to be based on the momentum in this case. It always is on earnings or on the events like this. So it's definitely going to be in the direction of what has happened prior, what institutions have done overnight, and then how everything develops in the morning. Could we just use the volume signature that we have? Yes, absolutely. Think about what happens on these 2 days where there is a gap. We are developing a climactic run to the downside on the climactic volume. What kind of action does this suggest? Stopping action, selling climax. And we have all of the characteristics of the climactic action. This acts more as a secondary test here. So here is our support line, different support lines and resistance lines that we could create. Look at the second example, kind of the same thing, climactic action. In this case, we're probably thinking that we are, okay, so initial phase A, B, and we're thinking, could we be in phase C here? Or maybe it's a much larger formation, and what we have is more of the weekly. On the weekly, maybe it will look differently. So look at the weekly, and you might say, okay, well, what if this is the area of the selling climax? This is the area of the automatic rally. Then what we have here is kind of like a secondary test in phase B type of action. So we might be inclined here to do what kind of trading? And this is, again, something that we do in practicum a lot. We think about all of these scenarios, right? Because through thinking, we develop logic that becomes a habit for us in the way how we think and how we approach the market. So we're thinking here, it's either secondary test in B or it could be C. In both cases, we're going to have some kind of rally, and this bar kind of shows that there is some demand. So we could have maybe like a swing trade up to this point, and maybe because this is a high-low, who knows, maybe there's going to be some kind of upthrust. So on the daily, coming back to the daily chart, okay, so our entry probably going to be either here or at the close here, or maybe on the reaction. And we're thinking that this is like a very risky trade, not a lot of potential. So again, not necessarily would be my favorite trade out of this place, but possible. So how would we do it? Okay, so let's say that this is our point of entry, this is our stop loss. Our target is slightly above 50, so maybe like 52, somewhere on this bar where the selling has started. So that's the goal. And we don't even have a really good, let's say if our risk is smaller. So what is this? 40 and 32. So maybe like $3. $3 of a risk for what? 40 to 50 for $10 of profit. Okay, acceptable, right? So we have 10 to 3, which is basically 3 to 1 about. Okay, well, let's go and do it. Bye-bye bar. Okay, so how are we feeling? Yeah, that's good, but the spread is diminishing and it goes into the resistance here, and the volume signature is still high, so some supply. So let's see how it's going to be absorbed. Oh, okay, I don't know what happened here. Okay, so we don't see that absorption, so I would be extremely concerned here as the price overcame. So there is no like reason for us to do trades like this. You already kind of could see where it's going with all of that. Okay, but let's continue. And this is that part of the simulator that I was talking about. Who was asking that question? I think either Philip or Nilesh was asking this question. Could we like use the simulator and see how the price fails? So if we had this as a potential smaller sign of strength, then we definitely don't want that failure to go and then fail again in a more meaningful way. So we would be completely out, and this would be just a break-even trade for us right here. And definitely we would need to establish some more definitive rules as how we get out of this. Okay. And as we got out, the price actually comes back. Okay, well, I think that we need a little bit more time to think about this, how this trade would develop. I'm just a little bit in the rush right now. But that would be the logic, in terms of the scenarios as to what do we expect to happen. And obviously, one of the things here is just the spread is diminishing, supply is diminishing as well. So I need to be a little bit more attentive to those details. Okay, second question. Stock charts by default and back by default add back the distributed dividends to the price. To remove the dividends from the price, we need to add underscore to the symbol. Is it necessary for us to remove the dividends from the stock price? Now, I definitely like it without the dividend. So as you could see, I don't have any underscores. So this would be a different picture here, or should be a different picture, although it looks the same, right? So underscore and then the symbol. So try it with some other stocks and you will see the difference. But basically, you could see that here, for instance, unadjusted, and then adjusted. Well, I guess I'm looking at the adjusted, right? So I always look only at the symbol. I know that with the underscore, obviously you get a different picture, but still, my preference is just to use the regular symbols. Okay, I think that's it. Will we discuss figure charts in practicum? I read Wyckoff books and it seems like important part of the method, or is it obsolete? No, it's not obsolete. It's probably considered obsolete by many technical analysts, or they just cannot find the quantitative evidence with the point and figure that it works consistently. That's what it is. Now, the reason why it might not work consistently for them is because they just use it incorrectly. And I'm just curious where. Oh, okay. Here's that failure. Yes. Okay, didn't even go to 50. Do we discuss that in the practicum? No, there is no reason to, because you could go to our on-demand products, and we have part number 1 with Bruce on the PNF, almost 8 hours. Part number 2, most recently constructed last year, I believe. So you have about 15 to 16 hours of material on the PNF. Also, if you go to our YouTube channel, you will find there a lot of, well, not a lot, but you will find on the PNF last presentation that Hank gave at Best of Wyckoff and his last presentation period. After this presentation, it was on Saturday. Next Saturday, he passed away. And then 2 30-minute intros to the PNF by Bruce. So you could definitely start with this, and then you could, switch to the products that we have. And those are great products. So I would just, there is no reason to go through the PNF. I mean, obviously I mention it here and there, but you could just buy it there. All right, guys, let's stop here. Let's kind of conclude our whole course. So last session, last 5 minutes, last comments, and so on and so forth. First of all, I enjoyed this group a lot. Each group is so unique, and it's obviously being comprised of the people who are in this group and how they are and how passionate they are about all this stuff, and what kind of questions they're going to answer. And I'm always like curious, what kind of group am I going to get for the next cycle? So I really enjoyed it, being with you and developing the material together with you. As you could see, I'm developing material as I teach this. And somebody sent me this wonderful quote that I'm going to read to you. It kind of states a different thing that I want to say, but I'm going to translate this in a different way. Teachers change lives, but students change teachers. And this is so true, because every time I have some kind of connection with one of you or with the group of you, I feel that the questions, the anxieties, the happiness that you bring to me in your emails and our conversations, they change me. They change the way how I teach. They change the way how I look at the markets, because any type of question that I don't know the answer to, and there are definitely a lot of those questions, like even today, to some of the questions I said, I have to look into this. So they develop me, they change me. So I'm in the state of appreciation to what you've done through this course for me. I know it might come a little bit as kind of like an unusual thing, but thank you guys. I appreciate it. I appreciate that you push me to develop myself better as a trader, as an analyst, as a teacher. Having said this, I hope that whatever you received in this course is valuable. And you've indicated to me many times, how valuable the material is, how you see the market better right now. I'm extremely happy for you. If you still in that space of where you are happy about the course, this is a good time to write a testimonial and send it to me. And we don't show the names of the students for testimonials, only initials, so don't worry about that. And we usually just collect the testimonials, and then we're working on the new website right now. So once it's gonna come up, we're gonna post those there. So if you have anything to say about the course or the way how I teach, please do so. I would be happy to receive that. Also, I want to receive some kind of feedback that you think is going to be constructive feedback on how to improve the course. I'm all ears. I want to hear that. And I have a lot of ideas, how to do this myself, but I want that feedback from students. So, don't shy away from shooting me an email and just say, Ramon, listen, what about this idea? Have you thought about that? And so on and so forth. Or maybe like, I want to suggest this as kind of like a potential improvement to the course. Uh, all of those are extremely valuable, and I'm extremely open to receiving those type of emails as well. The most important thing for you right now, guys, is going to be what do you do next? You spent 15 sessions, 15 weeks working on this material. If you're going to stop, most likely you're going to have a big drop in knowledge because it's going to just go away from you. And then you're going to try to kind of catch up. So the most inexpensive way to continue your education of Wyckoff methodology is just go to our YouTube channel, watch the recordings there. Go to the course again and do it again by yourself. Just go through the course by yourself, identify each week as one lesson, and then do the homeworks again and think about the homeworks and so on and so forth, and then find the way how to build your skill. If you don't have time for this and you want a more structured environment, then come back to us. Because if you are going to be in a structured environment, let's say in the practicum or WMD classes, and by the way, again, I'm giving you options to attend free sessions here, 4 free sessions. Do at least that. Orient yourself as to what's the next step. But one thing, do me a favor, one thing, do not stop learning this stuff because it's too complex, there are too many things, and you have to stay honest. And there are so many wonderful stories that our students have that have taken this course before, that have taken the practicum, that they have taken other classes, and after a year and a half, they've incorporated this and installed this as a habit, the way how they think about the markets. And the stories goes like this, and this is all true. I'm just kind of paraphrasing. A student emails me and he says, thank you for this course. After having, a couple of trades based on the way how now I understand the market after the course, we were able to remodel the kitchen. Another email goes like this. Thank you for the course. I was able to pay for my son's college education with the trades that I made, during the course. Another email. Thank you for the course. I made so much money on this particular trade. My husband has established a grant at the university of his alma mater. Those type of emails give us a sense of what kind of value we bring to people. And obviously it goes just beyond of like the money, the way of how people think, the emotions that come to that are extremely important. And also what's important, and I'm developing a lot of this, is the community. It's so hard to trade on your own. It's so hard to be disciplined. It's so hard to create the system and follow the system on your own. Not every person can do that. I have problems with this. So my life is all systems. I built system for everything, even like, for my physical exercises or anything like this. I need accountability. So if you're a person like that, if you need more knowledge, if you need more skill, come back to us. We have something that goes beyond just, the material of the Wyckoff Trading course. And other than that, just stay in touch. Shoot me an email here and there. Obviously, as you know, sometimes I might not reply right away. Sometimes I might send you to some classes, to answer specific questions. It's all about filtering, through the inquiries that I have. But let me know how your progress is going. Let me know what are the plans, for your trading. I'm curious about this, maybe something that I could suggest, and so on and so forth. So just stay in touch. All right, guys, that's it for this class. That's it for this whole course. Again, I really appreciate all of you. I appreciate you being here. I appreciate you signing up. I appreciate all of the comments, questions, and everything that you've done for this course. You've done something that is going to improve the course for the next cycles, and you people are going to be grateful to you that you've done that. So I appreciate that. Thank you guys so much, and I'll see you in the practicum, or just shoot me an email. Thank you guys, and bye-bye.